Hello and welcome to our session on stocks and stock valuation. Now, typically when we're going to look at the assigned reading for this session, which will be Ross, Westerfield, Jaff and Jordan, chapter 6 and chapter 13. Now, when we typically talk of shares represent an ownership stake in a firm, or what we call an equity stake. So when we set up a business and we are the owners, normally what we do is that we do have an equity stake, and this can be represented by shares in the firm. So there are times when, in seeking to expand, we need extra funds. We may choose to issue shares to raise money from other investors who also seek to have an ownership stake in the firm. This money is then used by the firm that issued the shares for the development and growth of the business. Now, in getting an appreciation of stock valuation, it would allow both internal and external players to the firm to put a value on the share of the firm, whether they want to do so for financing purposes, meaning that we want to look at the value of the firm or the share and see how it will influence how many shares we want to issue out there to raise a certain amount of money, or for investment purposes to determine whether or not we should invest, because stock valuation can be used to identify whether a stock is overvalued and therefore not worth holding, undervalued and therefore an opportunity to make money, or is at the market price. Now, this session seeks to equip students with some of the basic intelligence in the area of equity securities, their features, and their valuation. At the end of this session, students should be able to explain the features of common stock, understand the contractual rights of ownership, calculate stock value based on dividends, calculate stock returns, identify the basic characteristics and features of preferred stock, and also be able to value preferred stock, and also explain the concept of efficient markets. Now let's start by looking at what stocks are. Now, typically, like I did mention, stocks represent a share in the ownership of a company. And when you own shares, this ownership is represented by a share certificate. These days, however, we are able to represent ownership electronically through electronic share certificates, which makes it easier to buy and sell shares, irrespective of where you are. For that, I would want you to read on the Central Securities Depository in Ghana, and we will arrange a session with them later. Now let's look at the types of shares. Shares can be put into two broad categories to start with. We have ordinary shares. Now, these are the persons we call the true owners of a firm. They are the residual claimants, and they are the ones who can vote at a company's general meeting and take decisions concerning the firm. And they are eligible to partake in dividends or distribution of assets after everybody has been dealt with. So that's why we call them residual claimants. Now, the typical features of common stock: they have voting rights. They can vote by proxy, meaning asking someone else to stand in to vote or otherwise. We can have classes of such stock. And when we say those classes, these classes usually will assign certain voting rights for a certain quantum or have certain features. You're invited to read further on classes of stocks. And there are other rights that reflect they share proportionally in declared dividends. They also share proportionally remaining assets during liquidation. And of course, they have the right to vote on important matters like merging with another. And they also have a preemptive right, meaning that they get the first shot at new stock issue to maintain the proportional ownership they already have, if so desired. When we talk of preference shares, the name speaks for itself, meaning that it's giving some kind of preference. So even though they are also shareholders, they are normally not considered the true shareholders because they are more of a hybrid position between debt, which requires a fixed amounts to be paid more like in the form of interest, but then they are shareholders because usually the lifespan is similar to ordinary shares. So preference shareholders usually get some priority over ordinary shareholders in terms of payments or dividend and other payments when the company is winding up. Now, in general, there are varying degrees of preference shares that have different rights and characteristics. And holders of preference shares are entitled to having a fixed periodic income, like I indicated earlier, and typically do not have voting rights. Now, let's look at some examples of preference shares. We can have convertible or non-convertible shares. And as it indicates, convertible shares give the holder an option or rights where they convert into ordinary shares at some agreed terms and conditions. Non-convertible, therefore, does not have the option, but has all the other normal characteristics of preference shares. We also can have redeemable and irredeemable preference shares. Redeemable preference shares means they have a maturity, at which time the company will repay the capital amount to the preference shareholders and discontinue the dividend payments, meaning that the preference shareholding comes to an end. Irredeemable means they do not have a maturity and the dividends are fixed literally for as long as the company is in existence. We also have participating preference shares. Now, these ones have an additional benefit of participating in profits of the company apart from the fixed dividend. And of course, these will come with terms and conditions. And we have other preference shares which do not participate, and these we refer to as non-participating preference shares. We can also have the preference shares showing features of either having the cumulative feature or the non-cumulative. The cumulative feature means that in the event that the firm is not able to declare and pay dividends, remember that preference shares typically have a fixed payment almost like debt, then the dividends that could not be paid in a previous period are accumulated and therefore paid before any of the amount left is paid to the true equity shareholders. Non-cumulative means that if the company does not pay dividend in the current year, the claim of the preference shareholder is lost to that extent. And then we also can have shares with callable options, meaning that the company can actually redeem the preference shares in between. And of course, if they have to be redeemed, such preference shares will be redeemed at a premium. And the company will exercise such an option if the rates at which preference share dividends are being issued, or the rates for which you can, the rates at which you pay dividends is falling on the market with regards to preference shares. Now, so if you look at the typical features of preferred stock, their dividends are stated, and normally they must be paid before dividends can be paid to common shareholders. Now, note that typically dividends are not liability of the firm. And so preference share dividends can be deferred indefinitely. Now, most preference shares are typically cumulative, meaning that any missed preferred dividends have to be paid before common stock dividends are paid. And preference stock generally, like I did mention, do not have voting rights. Dividends are typically not a liability of the firm until the dividend has been declared by the board. So it means that once it's declared, then it becomes an amount that the firm has to make good on. So a firm cannot go bankrupt for not declaring dividends, and dividends are usually not considered business expenses, so they cannot be deducted before taxes are paid. And the taxation of dividends received by individuals depends on the holding period. Now let's come to the concept of valuing common stocks. As earlier indicated in previous lessons, the value of any asset is typically the present value of the expected future cash flows from holding on to that investment. So when you look at stocks in particular, be they typically common stock, then there's the avenues for making cash flows will be the receipt of dividends, if any, and then capital gains or capital loss, as the case may be. Dividends from holding on to, and then capital gains from price appreciation or otherwise. Now, based on the behavior of dividends in particular, we can have valuation under different scenarios. We can have the valuation where there's zero growth in the nature of the dividends, or we can have constant growth scenarios, or we can have differential growth scenarios. Now, let's try to put this in perspective. Now, suppose you're thinking of purchasing the stock of a company, an oil company, for example, and here you expect it to pay a 2 cedi dividend in 1 year. Now, clearly listen to the language. You expect it to pay. So that's an expectation. So that is in the future, it will pay a year from now, it will pay 2 cedi dividend. And you believe that should you sell the stock exactly a year from today, you are going to have 14 cedis. Now, if your expected return or your required return on investment of this particular stock is 20%, then clearly we would have to evaluate and find out what should be the maximum that you'll be willing to pay. So we're going to first identify the cash flows to be received from this investment, and we're going to discount appropriately. So we're going to receive a 2 cedi dividend a year from now, and then a 14 cedi sales price for the stock. Now, when we discount them at our required return of 20%, given our risk profiling, it means that the value of the stock, the maximum that we'll be willing to pay for, is 13.33 cedis. What this means is that if the stock happens to be selling for less than 13.33, that is much better deal, because then we get to invest less in anticipation of better payoffs in the future. We can also derive this by using the formula below in the Excel framework to compute the present value of the stock based on the cash flows. So now let's look at the case where, assuming that for the dividend to be paid, this dividend will remain at the same level forever, meaning that the dividend will not grow in value. What this implies is that dividend 1 will be in the same value as dividend 2 and as dividend 3. Now, since future cash flows are constant, meaning that the value of a zero growth stock will be the value of perpetuity, meaning it's a constant amount into perpetuity, which brings up a perpetuity formula. In this case, the price of the stock, given that the cash flows from stocks, in this case, the constant payment will be referred to as dividend. We have the dividend divided by the required rate of return, R. Now, in the event that we are faced with a constant growth scenario, it means that the dividends will be growing at a constant growth rate of G forever. What it means is that dividend 1, meaning that dividend at the end of year 1, will actually be the most recent dividend we know of, which was maybe paid last year or today, with a factor of 1 plus G, which is the anticipated growth rate. Now that gives us the end of year value for dividend 1. And then we can also have it growing by that same constant growth to develop dividend 2, and it goes on to dividend 3. Now this becomes the case where we now have a constant growth, and that will be reflected therefore by the formula that seeks to look at the present value of a growing perpetuity given by the function P naught is equal to the dividend divided by R minus G. Now, what you can see clearly is that the price for today is a function of the next year's dividend, which is expected to be under constant growth mode, divided by the required rate of return less the constant growth rate. So let's look at an example. So if dividends are expected to grow at a constant G% per period, using the original formula where we'd have, for example, the first year dividend being discounted, the second year dividend, now we know that the most recent dividend that was paid yesterday would grow by a G factor to the exponent 1 to give us year 1 dividend. And it goes on to give us year 2 dividend. And then we also discount them accordingly for the period. So with a little algebra and some serious work, this will reduce to the formula work we have as the dividend into the constant growth factor divided by or scaled by R minus G. So let's try our hands on example. So if a firm just paid a dividend of 50 pesos, so if it just paid, it means as we speak now, it's more of, that's the current dividend on the ground. So that's not an expected dividend. Now it is expected to increase its dividend by 2% per year. Now the silence on it means that this is going to be into the indefinite future. So if the market is requiring a return of 15% on assets of this risk class, how much should the stock be? So going back to the present value of a growing perpetuity, we're going to look at div 0, meaning that the most recent paid dividend, which was just paid 50 pesos, expected to grow by 2% and then divided by the required return of 15% less the growth rate of 2%. What it means is that the maximum price you should be willing to pay for this particular stock is 3.92 cedis. On the other hand, it's not always the case that the growth is either 0 or constant. We actually can have differential growth, meaning that we can have supernormal growth at certain points before, as a typical business, it settles into a constant growth mode. Now, with that kind of dividend, what we need to do then will be, for one, we're going to estimate the future dividends into the foreseeable future. And then we are going to try to estimate the future stock price when the stock becomes a constant growth stock, as we did in case 2. And then we're going to now compute the total present value of the estimated future dividends and the future stock price at the appropriate discount rate. Now, if you go back to the constant growth rate, for example, per this formula example, what it also means is that if you have dividend for period 2, and that dividend is a constant growth dividend, you should be in a position to compute the price for year 1. The same principle therefore holds that if you have constant growth dividend for period 5, meaning you have dividend 5, you should be able to compute the price for period 4, meaning you can compute P4. So by using that principle under the differential growth, it means that once you're able to estimate the stock price at the point where the stock becomes a constant growth dividend, constant growth stock, you should be in a position to then value by applying the principle of valuing all the dividends to be received whilst holding on to the investment and valuing the price or discounting the price accordingly. So let's look at an example. A common stock, we are told, just paid a dividend of $2. Now, this dividend is expected to grow at 8% for 3 years. Then it will grow at 4% in perpetuity. So what it means is that if it just pays the dividend, it means we have D0 or dividend for right now times 0. We can therefore determine the dividend for period 1, period 2 and period 3 because we are told that it's expected to grow at 8% for 3 years. Then it will grow at 4%, meaning that starting year 4, and therefore the dividend in year 4 will be experiencing a constant growth. Now, if we know that discount rate to be 12%, then what should be the value of the stock? Now, clearly we know dividend 0, so 2, and we expect it to grow to give us dividend 1 with 8%. And that dividend 0 with a 2-year compounding factor will give us dividend 2, and it goes on to give us dividend 3. And with dividend 3, we can actually then factor in the 4% constant growth framework to arrive at dividend 4. With dividend 4, using the constant growth formula, we should be able to then do dividend 4 divided by R minus G. We are told that R is 12%, and in this case, the constant growth rate of G is 4%. So that gives us the 12 minus 4, giving us the 8. Now, once we're able to do that, it gives us the price for period 3. And of course, what it then means is that we have dividend for period 1, which is this, dividend for period 2, dividend for period 3, plus price for period 3, and we discount them accordingly at the appropriate interest rate. That gives us a present value of $28.89. What it means is that with this information, with this data, the price at which we are willing to buy the maximum price is about $28.89. Now, we need to find out where R can come from. Whenever you do invest in a stock, for example, your return can be broken down into 2 parts. The dividend yield, like we learned with bond valuation, the current yield, plus any growth rate that we have in dividends, which in a sense for stocks will also be represented typically in the price appreciation, so which becomes more like a capital gains or capital loss in this case. So that's how we come by determining the R in terms of stock valuation purposes. In practice, however, there's usually a great deal of estimation error, and so that becomes a skill that one has to develop over time. Now, let's start by trying to use the dividend growth model to find the R. So if we have the price of a stock today being a function of the expected dividend, when I say expected dividend, it is the current dividend factored into the growth rate will tell you the expected dividend a year from today divided by R minus G. That means we can easily solve for R by rearranging and realizing that this, the dividend over the price, plus the G. So dividend over the price is what gives us the dividend yield. And then we have the growth rate, which like I indicated earlier, can actually be also a reflection of the capital gains that is reflected in the particular stock. Now, if, for example, a firm elects to pay lower dividends and reinvest the remaining funds, what the expectation is that the stock price may increase because future dividends may be expected to be higher. Now, for that matter, it's important to have an understanding of the payout ratio, the plowback ratio, and also the sustainable growth rate, which we have met much earlier in our lessons. So for the payout, that's a fraction of earnings that we pay out as dividends. Plowback is a fraction of earnings that we retain and plow back into the firm to grow. And so the sustainable growth rate is a stable growth rate at which the firm can grow. And this can be proxied by the return on equity multiplied by the plowback ratio. So that's how the G is derived. The G is the return on equity times the plowback ratio. So now let's look at an example. Our company has forecasted to pay $5 in dividend next year, which represents 100% of its earnings. It means if it's paying the entire 100% of its earnings, there will be no retention, so no plowing back. Now, this will provide investors with a 12% expected return. Now, if instead we decide to plow back 40% of the earnings at the firm's current return on equity of 20%, what is the value of the stock before and after the plowback decision? So clearly, if the firm were to pay the $5 dividend next year, all of its money goes out. But if it retains 40%, it means that 40% of the anticipated $5, which will amount to $2, will not be going out, meaning that it will pay a maximum of $3 in terms of dividend. Now let's see how that plays out. Now, when it pays out all of its earnings as dividends, all things being equal, it will not grow because there will not be extra funds for expansion. So then, with no growth, the present value of the shares will be captured as the present value of the perpetuity. So $5 dividends divided by the required return of 12%. And that means that the present value of that stock, or the price of the stock, will hover around $41.67. Now, on the other hand, if the firm should retain 40% of the funds, it means 40% is the plowback ratio, and its return on equity, we are told, is 20%. That gives us a growth rate of 8%. Now, because it's going to plow back 40%, it means it will not pay the entire $5, but it will rather pay only $3 in terms of dividends. That means that the dividend will be $3 divided by the R, which is the 12% required rate of return, less the growth rate of 8%. That means we're going to have 3 divided by 0.04. And we are told that that yields a present value of $75 per share, meaning that the growth impact changes the, so for the firm that is paying out all its money as dividends, its price will be reflected in the 41.67. And the firm that decides to reinvest and give an expectation of higher dividends in the future will be priced accordingly by the market to reflect a $75 price. Now, if the firm, so like I did mention, when it does not plow back any, it will remain at 41.67 in terms of pricing. With plowback, it rises to 75. Now, the difference between the two numbers, that is without the growth and with the growth, will result in the difference of the two numbers, which we refer to as the present value of growth opportunities. And so the present value of growth opportunities is usually the net present value of a firm's future investments. Now, when it comes to valuation, other analysts also relates to earnings per share to price to find a way for valuation. So we normally have what we refer to as the price earnings ratio. And with relevant data, you should be able to determine the value of a firm based on the P ratio multiplied by earnings to be able to then also divide by the number of shares to give you a sense of the stock price. Now, so this is what we have for the price earnings ratio. It means what's the price per share and the earnings per share. And that is something you'd want to read further on to understand. Now, in general, when we are reporting stock details from the stock market, these are some of the basic details you would find. That over the last 52 weeks of trading, that's the highest price that the firm has garnered. So in this case, for GAAP, the price over the last 52 weeks has gone to the farthest of 25.72, and the lowest has been an 18.12. So of course, we know the name of the company, which is GAAP Incorporated. And we are told that in terms of dividend, it pays 18 cents per share, or it just paid 18 cents per share. And that gives us, with the current price, the dividend yield of the company is 0.8%. So here we can see the P ratio, which then would mean that at any point in time, the current price of the firm could be 18 times its earnings, or the current value of the firm. And then we have the number of shares that have been traded in the last day's trading, and then the price at which it closed for that particular last trading. So it ended at 21.35, which has remained unchanged. So the next change is. Now, when it comes to stock pricing or the value of shares, the evidence shows that movement of stock prices from day to day do not reflect any particular pattern. So statistically speaking, the movement of stocks prices is quite random, which gives rise to the random walk hypothesis or the random walk theory. What this means is that sometimes it can be quite difficult to predict the pattern by which firm or stock prices would move. So this is a trend of data on stock prices using the S&P, and you can see that it looks quite random. So it can even be likened to a coin toss game. What it also then means is that it gives rise to what we sometimes refer to as the efficient market theory, or the efficient market hypothesis, that tries to map how easily or how well the price of a particular stock reflects the information available. So what the efficient market theory tries to indicate is that for a market to be truly functional, to be functional, the price of the commodities that are traded on that market should reflect available information, which typically will be demand and supply and other favorable or unfavorable information. Now, depending on which kind of information the stock prices typically reflect, or market prices reflect, we can categorize these markets into three broad forms, where we have the weak form efficiency. In this kind of market hypothesis framework, the market prices reflect all historical information. On the other hand, we can have a semi-strong. What it means is that it reflects all historical information and all publicly available information. And we have a strong form efficiency. It reflects all information, both historical information, publicly available information, sometimes mostly some private information, meaning that the market has captured all relevant information. What this means is that depending on the scenario, it should hold to reason that it should not be that easy for any investor to make abnormal returns by playing the market. Now, if you look at it critically, what it means is that the weak form is a subset of the semi-strong form, and the semi-strong form is a subset of the strong form efficiency. Now, let's look at the weak form. It means that we are saying that current prices reflect all security market information, including the historical sequence of prices, rates of return, trading volume, and other market-generated information. So past rates of return and other market data should not necessarily have a relationship with future rates of return. When we look at the semi-strong form of the efficient market hypothesis, it means that current security prices reflect all public information, including market and non-market information, for as long as it is public. This also means that decisions made on new information after it is public should not lead to any above average risk-adjusted profits from those transactions. Then we have the strong form efficient market concept. Now, this says that stock prices fully reflect all information from public and private sources. It also means that no group of investors should be able to consistently derive above average risk-adjusted rates of return from the market. This also assumes that perfect markets in which all information is cost-free and available to everyone at the same time, which we believe is more of an ideal or idealistic position. Now, looking at the efficient market hypothesis, we can get two groups of analysts who try to glean information for the purposes of decision-making or investment decision-making. We have the fundamental analysts who try to look at the fundamentals of a firm to be able to determine whether or not the prices at which the firms are trading truly reflect the information. And so these look at cash flows and other patterns, or more like a financial analysis of the firm in terms of prospects and all, to be able to look at the fundamentals and determine whether the price on the market reflects all that information and take a decision accordingly. Then we also have the technical analysts who try to forecast stock prices based on watching fluctuations in historical prices, trying to look for patterns where there may be any. In terms of what the efficient market hypothesis says, to a large extent, if the markets are truly efficient, then it becomes a bit difficult to make unusual or abnormal profits by playing on the market. Now, in terms of refresh, for valuation purposes, clear that the price today of any share of stock is therefore the present value of all future dividends to be made. And whether or not those future dividends will be expecting supernormal growth, constant growth, or zero growth, these all reflect accordingly in how the pricing is done. And also we should be able to decompose the required rate of return into the dividend yield and the growth rate of the firm. Let's end this class by looking at a few things you may want to. So one, what determines the price of a share of stock? What determines the growth and the rate of return in the dividend growth model? And you should be able to decompose the stock's price into the constant growth and net present value of growth opportunities value. We should also be able to discuss the importance of the PE ratio, that's the price earnings ratio. And that brings us to the end of our lesson for today.